Treasury yields have been rising. In this case, investors are worried that deficit spending is growing out of control. Core inflation is back near 3%, and if the US dollar loses some of its appeal, the market could fall because Treasury yields will rise. The second, we have concentration risk. As you can see, the top 10 companies now make up 40% of the entire S&P 500, and even crazier is that Nvidia now has the biggest weight in the S&P 500 of any individual stock since the data began in 1981. This is bringing us to a very close comparison to the early 2000s dot-com bubble, where at the time the top 10 companies made up just 25% of the index, which, hey, back then that was a big deal. However, even though market crashes have historically followed periods of high market concentration, like we're seeing now, the data actually shows that market concentration alone doesn't predict future stock market performance. Why? Well, sometimes market concentration is earned by fundamentally strong companies who make a ton of money, while other times it's fueled by speculative mania about to burst. That's why a more reliable indicator of a market bubble is simply how fast the market concentrates. And the faster this occurs, kind of like what we're seeing with Nvidia, the more vulnerability there is for a drop. Of course,